Okay. Starting off the question, guys, today, the question that we're looking to do is Peachco. So Peachco is a very important question, and we are looking to solve this particular question and get a good idea about how to go about the audit risk questions here. So starting off with our preparation and getting a strong base here. When we talk about Peachco, this particular question has multiple requirements. The first of the many requirements talk about audit risk. So what we have to find out, we have to find out 8 audit risks. What do we find out? 8 audit risks, and we have to also give the auditor's response. What is the risk? What is the response, right? So we have to find 8 of them. So that's our plan to focus on finishing this particular question. And where we're looking to find out what we are looking to find out the risk and the response for 8 audit risks. Okay, so let's get started here. Um, we have a summarization in the Excel of the same thing here. It will just help you during your revision. And here I'm just marking all the answers. So first is going back to the case so that we can start solving this particular question here. So in July, you are an audit supervisor of Apricot Co. This is the audit firm in which you are working, and you are an audit supervisor. Where are you working? In Apricot Co. And you are a supervisor. On 1st July 2005, it is the date today. You are an audit supervisor and you're working in a audit firm called Apricot Co. You have been assigned the audit of Peach Co. So your Peach Co is your client. And what does Peach Co do? It's a soft drink manufacturer and it sells to wholesale customers. And you're currently planning the audit, and you have received the following notes from your engagement partner. Your audit engagement partner, which is the highest position in an audit team, he has given you this particular notes. Okay. Materiality for the draft financial statement is 153,000, which is 5% of profit before tax. Right? They have just given you materiality information, not relevant a lot right now, but eventually as we go into question, you will see this will be useful. Right now, who you are a supervisor. Which company? Apricot Co. When? 1st July. You have been told you have to do the audit. Which company audit you have to do? Peachco. What does Peachco do? It is a soft drink manufacturer. And who does it sell it to? Wholesale customers. That's it. So who you are is clear. What you have to do, whose audit you have to do is clear. Next, what is happening is there was a meeting and your audit engagement partner, that means the head of the audit team, okay, the head of the audit team. Can you see it, buddy? Is it clear? Yes, sir. This one? Okay. As you come, you look at the screen. Okay, the head of the audit team. Okay, the head of the audit team. So what is happening here? The head of the audit team. What is happening here is the head of the audit team. The head of the audit team over here, that is called the audit engagement partner. What has he done? He has given you a notes. So this is the notes of the discussion that has happened. So first of all, who you are an audit supervisor. Which company? Apricot Co. And you have got a client. What is the name of the client? Peach Co. What does he do? Soft drink manufacturer. Who does he sell to? Wholesale. Wholesale sell to retail. Retail sells to customer. In that whole chain, you are looking into the manufacturer. Then your audit team head is called as audit engagement partner. What has he done? He has had a meeting with the main person there. They've not given the name. He had a meeting, and the following conversation happened, and now he's given us the notes of that conversation. So first of all, he's told that a new accounting system has been introduced. So here only first risk. This is the first risk. So whenever you see the word new, there's a good chance there will be a risk here. New accounting system is the risk. What is the first risk? Audit risk. A new accounting system. What is the first audit risk? New accounting system. Now, why is it a risk? Okay, why is it a risk? Okay, the risk over here is, why is it a risk over here? Now, the question is, why is it a risk over here? Because what did these guys do? It has been successfully tested. It had been successfully tested prior to implementation. They tested it. Okay, before they implemented, they tested, and they had such a confidence on the new system that after implementation, they did not test only. Before implementing it, they tested. After implementing, they didn't test. That is the risk. They should have tested it after implementation also. Why is it a risk? Why is it a risk? Why is it a risk? There is a risk because there's a risk that the opening balance of the new system and loss of ongoing data. So when you have transferred from old system to new system, some data would have fall out. So after implementation also, you should have tested it. Right? So when from the old system, new data, the data was migrating to the new system, some fallouts would have happened. Right? And also there's a risk that the balances that were transferred, that was wrong balance. There's a risk of opening balance on the new system being misstated. And the loss of ongoing data. If the data was ongoing, the loss of ongoing data will happen. When you're transferring from old system to new system, in between fallout will happen. And the data, the balance that has been transferred from the old to new, that balance only will be wrong. Right? The balance that has been transferred from old to new, that balance will be wrong. And when you're doing the transfer, some fallouts will happen. There's a risk of opening balance on the new system being misstated, and there's some loss of ongoing data. If the transfer is not done correctly, there will be some loss, and the new data that the new balance that is there in the new system, that will be a wrong balance, right? So what will be the impact of such a situation? What will be the impact of such a situation? If the new system is not operating efficiently, there's a risk of misstatement of accounting records. What is the risk? There's a risk of misstatement of accounting records. So what will be the impact of this? First of all, what is the main risk? That your accounts will be misstated. First of all, what will be the main risk? If the new system is not operating effectively, there's a risk of misstatement of accounting records. What is the main risk? There will be a misstatement of your accounting records. So what is the risk? The risk of misstatement of accounting records. When we are transferring from old to new system, correct balance did not get transferred, and in the transfer data has fallen out. That is why this is a risk. And what is the impact of this risk? What will be the impact of this risk? The impact of this risk is that your opening balances may be misstated. What is the impact of the risk? That your opening balance in the new system, that will be wrong, because wrong balance has gone from old to new. From old to new, wrong balance has gone. From old balance to new, the old system to new system, wrong balance has gone. First thing. And if the wrong balance is gone, we can say that the new system, the accounting records will be wrong. The accounting records will be wrong. So what a result of this, what will be the impact? Your opening balances on the new system will be misstated. What is the impact? The opening balances will be misstated. That will be the impact. So what you should do as an auditor, what you should do? As an auditor, what you should do? As an auditor, what you should do? First of all, you should do detailed testing to confirm that all balances from the old system has transferred to the new system. First of all, what you should do? Detailed testing to confirm that all the balances have been completely and accurately transferred. That full transfer has happened. That the full transfer has happened. Minimum, first thing, that the full transfer has happened. From old phone to new phone, you have transferred everything. From old system to new system, you have transferred everything. Okay. Second, what they should do is, they should discuss with the management any issues that have happened after implementation. Discuss. Second, what you have to do is discuss. First, what you had to do was testing. Detailed testing of what? Whether all the balances have been transferred to old system, from old system to new system. First, you have to do detailed testing. First, you have to do what? Detailed testing. Second, what you have to do is discuss. Third, what you should do is perform walkthroughs to document the new system and test the controls in place. Perform walkthroughs. That get them with you in a call and tell them to explain the system to you. Get them on a call and tell them, sir, please explain the system to me, right? And document everything. Okay, and whatever controls are there, test those controls. That's it. So basically, you're going to someone's house, let them give you a house tour, right? House tour, you say, they will give you a system tour. That is called walkthrough. Their full system tour they will give you. And wherever they show you, see, there's a CCTV here, there's a security guard here, you do the testing. See the CCTV is working or not. See the security guard is sitting or not. Just as an example, I'm giving you that when they take you through the system, they give you a walkthrough, right? You make some notes, and whenever you see controls are there, you test those controls, whether they're working properly or not. So firstly, what you have to do? Detailed testing. Of what? Whether all the system from the old has gone to the new. First thing. Second, what you have to do is get them to give you a walkthrough of the new system. They'll tell you if this happened, then this happened, then this happened, then like that, then like that, then like that. Give them a walkthrough of the new system. And after they give you a walkdown, you keep making a notes of everything. And wherever you see controls are there, you test those controls. What are controls? Controls are like security guards and CCTVs, right? Anything that prevents the risk. So any controls that are there in the system, you test those controls. And finally, have a discussion with the management that after you implemented, did any issue happen or not? After you implemented, any issue happened or not? That is the first risk. So firstly, we identified the risk. Second, we explained why it is a risk. There's a risk of misstatement of accounting records. So this is why it is a risk. And then we explain what is the impact. Your opening balances will be wrong. And as an auditor, what you should do? First of all, you should do detailed testing whether everything went from the new system to the old, from the old system to the new system. Second, perform a walkthrough. And when you're making a walkthrough, make every notes. When you're performing a walkthrough, make full notes. When you're doing a walkthrough, make full notes. And wherever control are there, you do go to the testing. And also you should discuss with management whether any issues are there after the implementation, any issues are there or not. Discuss with the management after implementation, any issues are there or not. Discuss with the management after implementation, any issues are there or not. That is about audit risk and the auditor's response. So how do you identify this? The moment you see new, In the question you see new accounting system, there can be a risk there. And the bigger risk is that they did not do any testing after implementation. They did not do any testing after implementation. The biggest risk is they did not do any testing after implementation. Okay. The biggest risk is they did not do any testing after implementation. And the biggest risk is they did not do any testing after implementation. After implementation, they did not do any testing. Okay. After implementation, they did not do any testing. That is the biggest risk. After implementation, they did not do any testing. Moving on to the second one here. As you move forward in the case, let's look into the next one here. Okay. Next one. So we've got the first one here. We've got a good understanding. Second, Peach has been developing a new production process which will help to reduce sugar in the drinks. Very good. And development commenced on 1st November and the total amount was capitalized. So see, whenever they say all the amount has been capitalized or they say total amount is capitalized, there is a risk. Because see, maybe some amount should not be capitalized. Maybe some amount, little bit, should not have been capitalized. Why have you capitalized full amount? See, because if you want to capitalize, you have to meet the criteria. Maybe some cost did not meet the criteria. Why have you capitalized the total amount? That is the problem. So what is the risk? The risk is over here. Firstly, what is the risk? Firstly, the risk is, what is the risk? What is the risk? So what is the risk? Firstly, what is the risk? Development cost is the risk. What is the risk? Development cost is the risk. What is the risk? Development cost is the risk. Why is it a risk? Why is it a risk? Firstly, development cost is a risk. Why is it a risk? Let's explain why it is a risk. It is a risk because some cost should not have been capitalized. Some cost should not have been capitalized. Right? Some cost may be research cost. Some costs which have been research cost, which has been classified as expenditure. Some costs would have been research cost. Okay, they should not have been capitalized. Okay, so as a result of that, what will happen is that your assets will be overstated, your research cost will be understated. What will happen? Your assets is overstated and understated research cost. Because see, whenever you do development, some cost will capitalize, some cost will not capitalize. What these people have done, full cost they have capitalized. Some cost should capitalize, some cost will not capitalize. What these people have done, full cost they have capitalized. How do you know it's given over here? Total amount was capitalized. So if they give total amount was capitalized or they give all the amount was capitalized. If they give total amount is capitalized or they give all the amount is capitalized, what you should do? If they give you total amount is capitalized or they give you all the amount was capitalized. If they give you total amount is capitalized or they give you all the amount is capitalized, whenever you see the word all, whenever you see the word total, that is a risk. Why? Because see, some expenses should not have been capitalized. Why have you capitalized them? Some expenses should not have been capitalized. Some expenses should not have been capitalized. Some expenses should not have been capitalized. What they have done, all expenses they have capitalized. So what you should do, discuss with the management first of all. Discuss with the management. First, what you will do, discuss. That why have you capitalized everything? Did you not have any research cost? Why did you capitalize everything? First, you discuss with them. First, what you will do is you will discuss. Right? How did you define, how did you split research cost and development cost? How did you do the treatment? How did you identify? First, you will discuss with management. What you will do, you will discuss with management. Second, you will do a detailed review. You will review of all the costs that were capitalized. You will do a detailed review of all the costs that were capitalized. Second, what you will do, a detailed review of all the costs that were capitalized. Second, what you will do, a detailed review, whatever cost was capitalized, just see, is it correctly capitalized or not? If some things are not correctly capitalized, request the management, please remove this. Right? And finally, okay, that is about amortization. We'll get that. But this is the first risk about development cost. So what happens is all the costs should not be capitalized. Some costs you can capitalize, some you should not capitalize. What these guys have done, full cost they have capitalized. So that is why it is a risk. And as a result of that, what is happening? Your assets are looking bigger. Maybe it's not that big. By mistake, they have capitalized or purposely they have just to make the assets look good. It should not be so much. So that is your impact, that your intangible assets are overstated and your research expenses are understated. So what is a solution? What is a solution? What you should do? The audit team should discuss with the management, the accounting policy, that why did you do like this? First you discuss, why did you do like this? Second, do a total review of all the capitalization expenses and see if those expenses are meeting the criteria or not. If those expenses are meeting the criteria or not. Okay, so that is about the first risk. Another risk hidden over here is of amortization. Right? If you've capitalized everything and then you've amortized it, then your amortization is also overstated. Right? Your amortization is incorrectly stated for sure. Why? Because first you capitalize everything and then you amortize that expense only. First you capitalized everything and then you amortize that expense. So if that expense is only wrong, the amortization also will be wrong. If your capitalization is only wrong, then your amortization will also be wrong. Okay, so there is a risk that the amortization has not been correctly calculated. There's a risk that the amortization has not been correctly calculated. For the period, amortization is not correctly calculated. So what you should do as an auditor, recalculate. What you should do as an auditor, recalculate. They should reperform the amortization. Discuss with the assessment of the useful life of the product. How did they get the useful life? We talk to the directors that, bro, how did you get the useful life? And how did you get the useful life? And then reperform the amortization. To discuss with the auditor, ask him, how did you get the useful life? And along with that, reperform the amortization and check if it is correct. You yourself perform the amortization and check if it is correct. That is the second thing. Development cost. That is the risk over here. Okay. Next, as we move forward, we look into next question. Peachco holds inventory of 227. What Peachco does, they have an inventory of 227, which it can no longer sell due to lack of demand. So, which they can no longer sell due to lack of demand. The director believes that Peachco can sell the remaining inventories to an international price customer at a price marginally exceeds cost. Peachco will be responsible for all the cost of delivery and shipping. Okay. There's a fall of demand in the home country. There's a demand has fallen. Okay. So how much inventory they have? $227,000 and the demand has fallen. So what is the risk over here? The risk is of inventory valuation. What is the risk? The risk is of inventory valuation. What is the risk? The risk is of inventory valuation. What is the risk? The risk is of inventory valuation. What is the risk? The risk is of inventory valuation. Now, why it is a risk? Why is a risk? There is a risk that the NRV is below cost. What is the risk? The risk is the NRV is less than cost. What is the risk? The risk is that the NRV of the inventory is less than the cost of the inventory. Why? Because demand has fallen. And if your NRV is less than cost, you have to write down your assets. You have to write down your assets. But nothing has told over here. So your inventory is overstated and cost of sales is understated. So first of all, what is inventory valuation? What is the risk? The risk is that demand has fallen. So because demand has fallen, your NRV has fallen below cost. And inventory should always be recorded at the lower of cost or NRV. Inventory should be recorded at the lower of cost and NRV. So what you should do is you should record the inventory at the lower of cost and NRV. So here the inventory will be recorded. Here the inventory is recorded at the or the cost only. And if that is the case, then your inventory is overstated. Then what you should do as an audit team, first discuss what you should do, discuss with the management the belief that the inventory can be sold and should review any agreement with the international customer. First of all, discuss with the directors their belief that the inventory can be sold at cost. First thing. Second, okay, so that is first about the cost. Now we'll come to the international customer, but this is what you can look into cost. Okay, that first, what is the problem is demand has fallen. If the demand has fallen, there's a good chance that the goods that are there with you right now, their NRV would have gone below cost. That is net realizable value should have gone below cost. And if your NRV has gone below cost, then you have to write down your inventory back at the lower of the NRV and cost, lower NRV. These guys have not done it. Inventory is overstated. So first discuss with the management. Discuss with the management that why have they calculated, kept it at cost? Why have they not written down? Ask them to write down. You what you will do is you tell them to write down the inventory and discuss with the management if a write down of inventory is required. Tell them to write down the inventory. That's it. Tell them to write down the inventory. Yeah, okay. Discuss with the management. Tell them to. Ha. Tell me, dear.
They're selling the inventory to the international customer a bad cost or below cost.
In excess
I
of
don't
cost.
understand.
हाँ, okay, I'll get into that part, इंटरनेशनल कस्टमर वाला. बट डिड यू गेट अ हैंग ऑफ दिस कि डिमांड गिरने से क्या हो गया है कि दे कैन बी नो लॉन्गर बी
Yes, sir.
सोल्ड इन द होम मार्केट. पहली चीज, ठीक है, ये लोग होम मार्केट में बेच नहीं सकते अभी. ओके. तो इसीलिए कहीं ना कहीं इसका देयर इज अ रिस्क दैट द एनआरवी इज एक्चुअली फॉलन, कि सेलिंग प्राइस कॉस्ट से भी कम गिर गया है. जब डिमांड है नहीं तो द एनआरवी हैज फॉलन बिलो कॉस्ट. एंड इन्वेंट्री शुड ऑलवेज बी वैल्यूड एट द लोअर ऑफ कॉस्ट एंड एनआरवी. इन्वेंट्री की वैल्यूएशन हमको हमेशा कॉस्ट और एनआरवी के लोअर पे करना है. तो यहाँ पे देयर इज अ चांस दैट इन्होंने
Yes,
वो नहीं
sir.
किया. देयर इज अ चांस दैट इन्होंने नहीं किया, और क्योंकि इन्होंने नहीं किया है वो, तो आपका इन्वेंट्री ओवरस्टेटेड है. आपका इन्वेंट्री ओवरस्टेटेड है और आपका कॉस्ट ऑफ सेल्स अंडरस्टेटेड है. ठीक है. तो एज अ ऑडिटर आपको क्या करना है, दैट फर्स्ट ऑफ ऑल यू हैव टू डिस्कस विद द डायरेक्टर. फर्स्ट ऑफ ऑल वी विल डिस्कस विद द डायरेक्टर that we think that you have not correctly, why the rationale for not writing down the inventory. Second, discuss the management if a write down is required. ठीक है. नाउ कमिंग टू द इंटरनेशनल पॉइंट ऑफ व्यू. बट इन लोगों को क्या लगता है कि इंटरनेशनली ये लोग बेच सकते हैं. पर अगर इंटरनेशनली ये लोग बेचे एंड इफ दे सेल इट इंटरनेशनली, द प्रॉब्लम विल बी दैट दे विल हैव टू incur a lot of money. So the selling price might go below cost also. Because they sell it to international customers, they'll have to pay a lot of money. So the selling price and ultimately the NRV, कि जो हाथ में आना है पैसा. What is NRV? NRV is what money comes in your hand after all the selling expenses. So here, after incurring all the selling expenses, there's a very good chance that your NRV would be below cost. के बिकॉज इतने ज्यादा और एक्सपेंसेस आ चुके हैं. लोकली ये लोग बेच नहीं सकते, इंटरनेशनली ये लोग को बेचेंगे. अभी इंटरनेशनली अगर बेचेंगे तो बहुत ज्यादा खर्चे आ रहे हैं. तो वो खर्चा जब ये लोग इनकर करेंगे, करते करते हाथ में जो बचेगा वो बहुत कम पैसा बचेगा. तो इसीलिए हम लोग, मैं बोल रहा हूँ कि इनका एनआरवी वुड हैव फॉलन बिलो कॉस्ट. अब एनआरवी क्या होता है? आफ्टर सेलिंग एवरीथिंग, व्हाट कम्स इन योर हैंड, व्हाट इज लेफ्ट. When you sell off everything, you incur all the expenses. What literally comes in your hand? I sold my laptop in OLX. I sold it for 20,000. Then OLX took some commission. So in my hand, only 11,000 came. So that 11,000 is called NRV. But how much did I sell it for? 20,000. But how much came in my hand? 11,000. In this case also, what is happening since they are selling abroad? So they are selling for a good amount, but so much more expenses are there that by the time what is left in their hand, it is very low. So the NRV would have gone below cost also. Leave selling price, NRV has gone below cost also. And if that is the case, they will have to write down the inventory. So though they are trying to sell it at an excess, but because there are so much more cost involved, so more than that, more than the selling price, the costs like delivery, cost like shipping, these costs will reduce your NRV below cost. So they're trying to sell it at an excess, but because of the extra expenses, their NRV will be below cost. Okay, so correct, they're trying to sell it at an excess. To answer your direct question कि वो जो selling price है वो excess ही है थोड़ा cost से. बट प्रॉब्लम क्या है कि इतने और खर्चे हैं कि हाथ में जो पैसा बचेगा सब कुछ बेचने के बाद, वो इतना कम होगा कि वो कॉस्ट भी कवर नहीं कर पाएगा. डिड यू गेट द आंसर हियर? टिया, लॉजिक समझ में आपको? कि कोशिश तो कर रहे हैं ज्यादा में बेचें, बट इतने सारे और खर्चे आ गए हैं कि वो लोग को जब तक पैसा हाथ में आएगा उनके बेचने सब करने के बाद, वो इतना कम रहेगा कि वो कॉस्ट से भी कम रहने वाला है. सो दैट इज द अजम्पशन. तो इनको क्या करना चाहिए? इन्वेंट्री शुड बी रिकॉर्डेड एट द लोअर. तो यहाँ पे इन्होंने नहीं किया है. तो पहले तो उनसे डिस्कस करना है कि भाई क्यों नहीं किया, और इंटरनेशनल का कितना खर्चा लग रहा है, क्या लग रहा है. सब पता करने के बाद, सब देखने के बाद अगर लग रहा है कि एनआरवी इज लोअर देन कॉस्ट, तब हमको इनसे डिस्कस करना. वील हैव टू डिस्कस विद देम दैट यू माइट नीड अ राइट डाउन. You will discuss with them that you might need a write down. You will discuss with them that you might need a write down. Yeah. Hello. Yes. Yes. हाँ मैम, करता हूँ मैम, थोड़ा सा काम मिनट का वो करता हूँ मैं आपको. आई विल कॉल यू इन अ बिट. हाँ. डन डन डन. ओके, मैं देखता हूँ मैम. या थैंक यू. Okay, so that is about this. Okay, so that is about this. Okay, because they are selling internationally. In international, there are so much cost. In international, there is so much more cost in international that by the time money comes into their hand, it is lesser than cost also. So first you discuss with them that what was the rationale why they feel that the inventory cannot be sold in the local market. Second, you ask them the documentation about international and what are the costs of shipping and transport and everything. After looking at everything, if you feel that the NRV would be even less than the cost of the asset also, then you have to consider talking to them that will you have to write down the inventory or not. That will you have to write down the inventory or not. You have to ask them, will you have to consider, will you have to write down the inventory or not. That is about this inventory valuation. Next is staff cost. Okay, as we go forward, we'll see. There were significant staff costs involving the preparing the site for the machinery and in testing the new machinery was operating correctly. These costs have been included within wages and salaries. So what they have done over here, they have included the cost in wages and salaries. Okay, they have included the cost. Despite the old machinery being sold at a loss, the directors of Peachco decided to extend the useful life on of an average by 5 years. This is the next risk. There's one more risk over here, but let's look into staff cost. So first, the risk is staff cost. They have put in wages and salaries. They have put the staff cost. Staff cost has been included in wages and salaries. Okay. So why it is a risk over here is because IA 16 what it will say that property, plant and equipment states that costs directly attributable to bringing the asset into working condition, working location are capitalized. These attributable costs, these include cost of site preparation and testing. So what they should have done, they should have capitalized this cost. That is why it's a risk. But what they have done, they have just expensed it. Right? What they have done is they have expensed it. What they should have done, capitalized it. But what they have done, they have expensed it. Okay, so as an audit team, what you have to do, you have to discuss, right? Just discuss with the management the accounting treatment that they have applied and request the relevant staff cost should be included in the cost. Tell them, please, sir, put it in the cost. You have put it wrong. First, you discuss with them, tell them to put it in cost. Where have they put? They have expensed it in P&L account. Where have they put? They have expensed it in P&L account. But where they should put it in cost. Okay. The audit team should undertake a review of the staff cost expensed and the process of allocating the staff cost to the work undertaken to confirm that what that should be capitalized as part of cost of machinery. If an adjusting journal entry is made, you should review the accuracy of that journal entry. If when you tell them to do it, they will do it. And if they on doing it, they will put a journal entry. You review that journal entry also. Right? You review that journal entry also. The audit team should undertake a review of the staff cost expensed and the process of allocating the cost to the work undertaken to confirm the amount that should be capitalized as part of the machinery. So first of all, you have to ensure that the correct amount has been capitalized. The amount that should be capitalized as part of the machinery. First of all, the audit team should discuss with the management. First of all, discuss with the management and request that the relevant costs are included in the cost of PPE. First is discuss with the management. First is what you have to do is discuss with the management. Okay, the audit team should discuss with the management the accounting treatment applied and request that the relevant costs are included in the cost of PP. Ensure that the relevant costs are included in the cost of PP. Okay, so first of all, what the audit team should discuss with the management. First, what you have to do, the audit team should discuss with the management and please request them that you put this in PP. Why are you putting it in expenses? First thing. Second, what you have to do over here is that consider the correct amount was capitalized or not. So how when you can do review all the costs that was expensed and how they have allocated the staff cost to the work. What is the allocation process? And after understanding that whatever amount is coming, you confirm that it's the correct amount or not. Right? And if they have made a journal entry for making the adjustment, review the journal entry also. Review the journal entry also. Okay, review the journal entry also. So that is about this. That the staff cost should be capitalized, but what they have done, they have expensed it. They should have capitalized it, but what they have done is they have expensed it. So what you'll do first, you'll discuss with them and tell them to please capitalize it. Don't expense it, please capitalize it. But when from expense to capitalizing they will do, there will be journal entry. That journal entry, you review it correctly, it is done or not. Right. Second, you look into all the staff costs that were expensed and see if that staff cost is correct or not. Right. Look into the staff costs are correct or not. And if it is, then just ensure that the same amount is capitalized. That is about the staff cost. That is about the staff cost. Second, what these guys have done, useful lives. So what they have done is, despite the old machinery is sold at a significant loss, During the year, Peachco has decided to extend the useful life of plant and machinery by 5 years. All the plant and machinery, they have increased the useful life. Why? Right? All the plant and machinery, they have increased the useful life by an average of 5 years. Right? By an average of 5 years, they have increased the useful life of the plant and machinery. The directors extended the useful life of plant and machinery by an average of 5 years. Why? Why have they increased? Despite all the machinery selling at a loss. Right? That means the machinery value is not at the market. So they're all selling at a loss. You're disposing of old machinery at a loss. Why are you increasing the useful life? Right? Why are you increasing the useful life? Right? So the risk is that. Why is this a risk? Right? The risk is that because the old machines that were there in their company, that is being sold at a loss. Still, these guys are increasing the useful life of other machines. Why? If your company machines are selling at a profit, then you can increase the life of the remaining machines. But your machines are already selling at a loss, and remaining machines now you're increasing the life. It does not sit properly. It just does not make sense. So what you should do? What would be the risk here? It appears that property, plant, and equipment is overstated. Depreciation is understated. Your property, plant, and equipment is overstated. Your depreciation is understated because see, when you increase the useful life, depreciation comes down. Yeah, when you increase the useful life, depreciation comes down. So that is why your depreciation is understated and your property, plant, and equipment is overstated. So that does not make sense. So what they have done is they have increased the useful life of the property, plant, and equipment despite all the old machines they are selling at a loss. So why have they increased? There's no logical reason only. No need to increase. Why have they increased? Right? Why have they increased? There's no need to increase. Why have they increased? Okay, this does not support the decision. Right? It appears that the plant and machinery is overstated and depreciation is understated. What you should do, first of all, discuss. Let's see, discuss is a common word, but exactly what you should discuss? First, you should discuss. Next, you will compare. Two things you will do. First is you will discuss. The audit team should discuss with the director the rationale that why have you increased it? Why have you increased the useful life? Give me a reason. Simply you got up one morning, you increased it. Why? Second, the revised useful life of a sample of assets should be compared to how often these assets are replaced and any gain or loss on disposal, as this provides evidence of useful life. What you can do is the useful life of a sample of assets, you take the useful life, compare to how often these assets are replaced. Compare it to how often these assets are replaced and any gain or loss on disposal, as this provides evidence of the useful life. So first of all, you take the useful life of a sample of assets and then compare it. Compare it to what? To how often these assets are replaced. Because see, if assets are regularly replaced, then useful life can be increased. But if you're not replacing your assets, how can you tell me that the useful life is increased? Doesn't make sense. Okay. And if the old machine that they've sold, the gain and loss on those machines. Okay. So first the audit team should discuss with the directors the rationale for any extension of assets. Second, you will compare the useful life of the assets. You will compare the useful life of the asset and compare it with the how often the machines are replaced. If they are regularly replaced, then you can increase. It still makes sense. If that is also not happening, then it doesn't make sense to do that. Also, the machine that have been recently sold, you ask their profit or loss. Or what were the sold? Profit they were sold, loss they were sold. You ask them. Okay, so this is with the useful life. Okay, this is with the useful life. A member of finance team was dismissed. It was discovered he was doing fraudulent purchasing of non-current assets for personal use. Uh, they had fired one person because he was doing, for personal use, he was doing fraud. For personal use, he was doing a fraud. Right? What he did, he fraudulently purchased assets for personal use. He took from company money. In the company's money, he's purchased things for his personal use. What is the risk here? The risk that he would have done so much more that we don't know about. Right? He could have done for so much more that we don't know about. Okay, the reconciliation of physical asset register will be ongoing, and hence there is a risk that non-current assets are overstated as they may include personal assets purchased. That you would have purchased more, and now they are there inside non-current assets. Then your non-current assets is more, not because your company has those assets, is that this guy would have purchased for himself, you have written in company's name. So your non-current assets may be overstated. So what has happened? Your control risk has increased. So this is a failure of your internal controls. So control risk is also increased now. As an auditor, you'll be like, yeah, the controls are not good. So you'll have to do additional procedures. So see, whenever control is not good, what do? You do more procedures. Right? So whenever controls are not good, what you will do? You will do additional procedures. So that's always the same. So whenever a control risk is more, you will do additional procedures. And what you should do again, discuss with the management, understand how the fraud were detected and corrected. How did you find it out? How did you correct? And then understand the internal controls in place to prevent other frauds also. First, you discuss with the management how the fraud was detected, how the fraud was corrected. Okay, discuss with the management how the fraud was detected, how the fraud was corrected. Then you have to understand the internal controls as well. And then additional procedures should be performed, particularly in respect of non-current assets addition. Then additional procedures should be performed, particularly in respect of the non-current assets addition. Additional procedures should be performed, particularly in respect of the non-current assets addition. Okay. So whenever risk is more, guys, you have to do additional testing. Okay. Whenever risk is more, you have to do additional testing. Whenever risk is more, you have to do additional testing. Obviously, you have to do an additional testing. Okay. When testing non-current assets, you'll have to do a lot more testing. When risk is more, you'll have to do a lot more testing. Yeah, okay. So that is the first thing. Next, you will discuss with the management, understand how the fraud was detected, how it was corrected, understand the internal controls in place to prevent other frauds, and see what are the controls in place to prevent other frauds. You have to understand that. Okay, that is fraudulent purchases. Next. Peach entered into a contract with a new supplier. Peach has committed a minimum of 150 orders. He will give order every month. He will give that much order. No costs have been accounted for to date, as no amounts are payable for the 6 months. For the first 6 months, you don't have to pay anything. The directors have not accounted for anything for the first 6 months. The directors have not accounted for anything over the first 6 months. New supplier. So see, basically the risk is the directors have not accounted for any cost, as no amounts are due to be paid after the year end. For 6 months, no amounts are due to be paid, so he didn't record anything. So what is the risk here? The risk here is that the cost incurred to date have not been recognized, and therefore the costs and liabilities are understated. Right? There's a risk that the cost incurred to date have not been capitalized, and therefore the cost and liabilities would be understated and profit is overstated. So what has happened is the cost and liabilities are understated and your profit is overstated. Okay, so what you can do, should review the terms of the contracts. What you do, review the terms of the contract to understand the amount payables. They should review what you should do, review the goods received not invoiced accrual listing to ensure that the amounts payable to the supplier for bottle receipts have been accrued despite not being invoiced. So basically, guys, see, you did not pay any money, agreed. You did not pay any money, I am agreeing to that. You did not pay any money, I agree. But in accruals, what happens? The economic event has happened. Cash movement has not happened, but the economic event has happened. And if the economic event has happened, you will have to record it. Okay. If the economic event has happened, you still have to record it. Okay. If the economic event has happened, you still need to record it. It's important. Okay. If the economic event has happened, you still need to record it. So here you should tell them that yes, they have not paid, agree, but economic event has happened, right? So you have to still record it as an accruals. You can't just leave it as it is. Goods have come, he's given you, you have started selling, and you're telling I'm not going to show anything to record because I have not paid him money. It's like still the economic event of he transferring the goods to you has happened. If the economic event has happened, you have to record. If the economic event has happened, you have to record. Okay. And also, Peachco supplier has launched a legal claim against Peachco. And they're saying, as estimated, the amount payable is the region 0.3 million we'll have to pay. They're likely to lose the case and we'll have to pay 0.3 million. So we have to recognize here. We have to make a provision here. Right? Minimum. Now see, someone has put a case on us. Someone has put a case on us. Someone has put a case. Someone has put a case on us. A previous supplier has launched a legal claim. So the risk is that the provisions have not been made. So provisions and expenses are understated. Right? If you've not recognized anything, it is understated then. The provision should have been made. So see guys, again, it is probable that you'll have to pay, so you have to make a provision, right? See, someone has put a case on you. Your lawyer is telling you'll have to pay. If you have to pay, you have to make a provision. But it doesn't seem like they have made a provision. So your provisions are understated. So what audit team you should do? You should look into the WhatsApp chat, right? Correspondence is obviously you write correspondence, don't write WhatsApp chat, but think of it as a WhatsApp chat, right? The correspondence is like a WhatsApp chat between the lawyer and the company, and see what is the likelihood of you losing the case and making the payment. See what is the likelihood that you will lose the case and you will have to make the payment. What is the likelihood that you will lose the case and you will have to make a payment? Okay. What is the likelihood that you will lose the case and you will have to make a payment? Okay. What is the likelihood that you will lose the case and you will have to make a payment? What is the likelihood of that? That you will lose the case and you will have to make a payment? Okay. What is the likelihood that you will lose the case and you will have to make a payment? Okay. What is the odds? So you'll have to look into that legal claim. Next, you have taken a new bank loan, right? You have taken a new loan of 1.2 million that you will pay over the next 3 years. So you should classify it between current liabilities and non-current liabilities. What is the risk? Whenever you take a new loan, what is the risk? You have to classify it between current and non-current liabilities. The risk is a new bank loan. And why is it a risk? Because you have to transfer it, you have to split it between current liability and non-current liability. You have to split between current and non-current liability. If you've not done that, it will give a classification errors and your liability will be misstated. If you've not done that, it will give rise to a classification error and your liabilities will be misstated. So as an audit team, what you should do? As an audit team, what you should do? You should undertake a review of the loan arrangement to confirm the details and reperform the calculations. Also, the finance cost should be recalculated. Also, the finance cost should be recalculated. So first of all, there's a new bank loan. So whenever there's a new bank loan, the Peach Co obtained a new interest-bearing bank loan in the year repayable. So first of all, you obtained a new interest-bearing bank loan. So what you have to do, you have to split between current and non-current liabilities. What you have to do first is you have to split between current liabilities and non-current liabilities. And that would give rise to a classification error and the liability is being misstated. So it would give rise to a classification error and the liabilities will be misstated. The first is new bank loan. So Peach Co obtained a new interest-bearing loan in the year repayable over the 3 years. So there was a new loan. So what happens? There's a risk that the loan has not been correctly allocated between current and non-current liabilities. There's a risk that the loan has not been allocated properly between current and non-current liabilities. So what you do is, we should give a classification error. Okay. So what you have to do is discuss with the management and that the correct what basis they have done the classification, and also you'll go to the loan agreement. Go to the loan agreement, see how much they have to pay this year, say how much you have to pay next year, and tell them to do the classification correctly. If you feel after reviewing that there's a mistake, tell them to do the classification correctly. Second risk is the finance cost paid in arrears may not have been correctly accrued. The finance cost would have not been calculated correctly, right? So you recalculate it once again and you check if it has been correctly calculated. The finance costs that are paid in arrears means paid 1 year later may not have been calculated accrued. Arrears means you pay it later. So what this does is it results in understated accruals and finance cost. Your finance cost and your accruals are understated. Your finance cost, so the finance cost, interest they have not calculated correctly. The risk is the interest they have not calculated correctly. What is the risk? The interest they have not calculated correctly. So you can recalculate it once and check if they have done it correctly. Finally, there are some covenants in place. Peach Co agreed to maintain a minimum net profit and also to meet specific targets. Right? That is called covenant. See, anyone who gives you money will put some conditions on you. So in this company also, the loan providers have put some condition. What is the condition? The condition is that you have to maintain this much net profit and you have to meet this sales target. If you don't, you have to return my money back immediately. Okay. So if you breach it, you may have to do the repayment instantly or you'll have to give some fine or penalty. If you have breached the conditions, the risk is that if you could have breached the conditions, you will have to repay the loan immediately. Yeah, you'll have to repay the loan immediately. Yeah, you'll have to repay the breach is that you'll have to repay the loan immediately. right? A breach of covenants could result in fines or penalties or mean that the loan should be instantly repayable, right? Could result in fines and penalties or mean that the loan should be instantly repayable, right? The loan should be instantly repayable. So what is it? There's an increased risk that the existence of covenants gives an incentive to manipulate. So there's an increased risk that the covenants will give a reason to manipulate the balances, right? They will purposely try to manipulate everything. So you have to tell your audit team to be very attentive to increase professional skepticism. You have to tell your audit team, see, these guys have covenants. And because if they don't meet the covenant, they'll have to pay fine. They will do everything to not pay the fine. So they will put wrong numbers also. So you be alert. Then you go through the covenants in detail. You understand what they should do. Then you recalculate to just see if any breaches have happened. You yourself recalculate. Whatever net profit was there, you calculate the net profit. Whatever the sales target is, you go through the sales numbers. And after that, you check whether there are breaches happened. And also be alert. During the audit, entire audit, you have to be alert. During the entire audit, you have to be alert. Okay. During the entire audit, you will have to be a lot more alert. Okay. So this is about the risk part.